with all of this, with the screens that you're running and the rebalance that you just completed, where do you see things going from here? What are your screens showing you?
Well, it's interesting because last year, when we rebalanced in late summer, early fall, my stomach was so tight I thought I had abs, and that's impossible. But it was just one of those situations where 33% of the portfolio ended up in consumer discretionary stocks. Mm-hmm. And I started looking, but the more I looked at it, the more I could see what was happening. It was the lower end of consumer discretionary stocks. It was the Ross stores. It was, for instance, if things are going to slow down, you're not going to go to Nordstrom's to buy your niece a sweater for a 6-year-old birthday that she's just going to grow out. Why not go to Ross? Mm-hmm. If you looked at AutoZone, a lot of people then in a slow economy will start to do their own work on their own car. You could look at, for instance, Corinthian College, and people said, well, people aren't going to spend money on college. Well, if you get let go and you need some more skills to get a better job, Corinthian College. And that all worked. It was really retail-oriented, discretionary. This year it's the same thing. 1/3 of the portfolio is going to be in consumer discretionary, but what we saw from there is it's gone to different sectors. So the theme that I'm working with, that I think the United States is really working with, is that more for less. People want more for less. If you look at it from a logical standpoint, a year and a half ago, a lot of people would not go into a Walmart because it was beneath them. Just wouldn't do it.
Right.
Now they go in and they find out they have everything, from fishing gear to clothes to this to that, and you go, huh, are they going to go back? Yeah, they're going to go back because they're not spending as much money, but they're getting more.
Right.
So if you start to look at something like that, you can still look at a Ross. You can look at Carter, which I never knew this company, Carter, before, but they make the clothes for Walmart and Target. That's interesting. If people aren't going to eat out as much or things like that, what about Tupperware? That makes sense for leftovers. Huh? If you think if people aren't going to eat out and they're going to save some for leftovers with Tupperware or whatever, they might be now starting to look at canned goods. Right. Instead of frozen goods, instead of fresh goods, and especially in the vegetables. And if you think about it, I never knew this company until I had to buy it, which was a company called Ball Corp, B-A-L-L Corp. And I asked myself, my God, what do they do? Well, as of this morning, they had already made 45 billion cans this year alone for the canned food industry, for Del Monte or whoever's going to end up canning their food. And so you think about it, people now are buying canned food. You can put them in a drawer, you can put them on a shelf, they're not going to go bad, use them when you want, and you put them in a soup bowl or whatever, it's not going to taste any different as if it was frozen.
Right.
So there's a lot of unique opportunities out there that people are just changing their spending habits and getting more for less. And I think that's going to go into the future, because once you get into a habit, you just don't change it, and you just don't go from canned foods back to Smith & Lewinsky's. You just don't do it.
Well, with that, are there any sectors that you feel like should be avoided?
Yeah, it's interesting. This year, when we did the rebalance, utilities went out. And I started thinking about that. Why would utilities go out? Because everybody needs electricity or gas or whatever's going on. But people are changing their habits there too. Maybe they're not going to heat their hot tub. Say, well, money's tight, we're just not going to do it. Or their pool. Or instead of cranking the air conditioning to 70, they're going to leave it at 78. There's a lot of different reasons. Or, for instance, I'm not sure if you have kids, I got 5, but when I tell them to turn off the lights now, I mean turn off the lights, shut the door. And I mean it. So as we go forward, I don't see the utilities making as much clearly as some other sectors. The other sector that's really interesting that I do not like and isn't in our portfolio is technology. And people go, why technology? Everybody's talking about technology, how their balance sheets are strong and this and that. And that's all true. The big companies, the Hewlett-Packard, Cisco's, their IBM's, they're going to make money. The problem with technology as a whole, as a concept, is there's nothing that I see out there that's going to change the way we live and work. In other words, go back to the 80s. What changed the way we worked and lived? Personal computer. Going to the mid-90s, what changed how we lived and worked? Internet. I don't see anything out there. So what you're getting is a great play off of say, Apple. Because all they're doing is taking the technology, repackaging it, making it prettier, and selling a product. They're not selling an industry, like we have with personal computers and the internet. So I don't like that sector. But at the same time, what is a good sector to be in?
What's that?
Information solutions. And most people don't talk about that, but that'd be like a Broadridge, computer science. And the reason I say that is now that the companies have laid off all these employees, Ben, if you think about it, when everything's going really well, just don't disturb it. We got all these employees. If things slow down, you start to let go of the employees. Well, you probably should have let go of them during the good times and put money into technology, but you didn't. So now times have slowed. Now you get rid of your employees. Now what are you going to do with your money? How are you going to expand your margins? Well, one way is hiring an information solution expert like a Broadridge, computer science, or whatever to help you with your technology. Put new technology in, which is not new, it's just been there. Put it into your company, and two things happen. Number one, you don't have to hire back as many people.
Right.
And number two, you capitalize that cost. It doesn't go against your earnings right there like an employee does, like a benefit does. So from a balance sheet, from an earnings per share standpoint, by employing the technology, you're going to look that much better. And so companies are going to get healthier as we go forward. And that's why I say the big tech companies are going to do fine, because there's a lot of companies that have to either upgrade or implement the technology into their business going forward.
With that, what would be your best piece of advice for investors over the next year?
Well, the first thing I would tell them is you got to stop going into fixed income. I mean, this is just crazy, because normally everybody does the same thing. They run the same way. And you're 70, 80, 90, 100% of the money going into mutual funds going into fixed income, and that's just crazy. Because at some point in time, somebody's going to wake up and say, I'm not making any money in my fixed income investments. But the thought process today is, I just want the same amount of money as I had yesterday. So we still have a crisis of confidence. If they can let go of that crisis of confidence and understand that not all companies are going broke, and they weren't going broke in the March era either. In fact, 27 out of 30 Dow Jones stocks in March were making tons of money. There was AIG, General Motors, and Citicorp that weren't making money, but the other 27 out of 30 were making money, and lots of it. The same is true today. It's not that we're going broke. The country isn't going broke. There's no doubt. The banks are getting healthier. If you have the stomach and you just say, hey, look, I'm looking out long term, you're going to be fine. Because one thing we understand now, and one thing that everybody even understands across the waters, is that leverage isn't a great deal. And real estate doesn't necessarily all go up. And so this has happened before. It will happen again. But going forward, I think that we're in great shape. Companies are in great shape, and it's tough to find bad news out there. It really is tough to find bad news, but the media still reports it, whatever it is. You know.
So, what's your outlook for earnings going forward with these Dow 30?
Well, I think you're going to see revenues pick up, and it's just going to drop to the bottom line. So, you know, and I've been saying this for the last 6 months, that you're going to see, you know, earnings in the fourth quarter of this year and first quarter next year be very surprising. In fact, I was saying that last January as everything was collapsing. I was sticking to the story simply because you can look at AOL last December wrote off $18 billion worth of intangibles. What do you think their quarter over quarter earnings are going to look like?
Right.
This isn't rocket science. And I think the problem that investors have been more than anything else is they outsmart themselves. and they make their investment decisions so much more difficult, and they complicate their lives at the same time. You know, it doesn't need to be that complicated. I mean, I sort of look at life as every day is Christmas, so you know, you just go through with it.
Right. So you see earnings going forward as being much more sustainable and much more grounded in reality.
It's going to be trading off earnings, dividends, return on investment, return on capital, cash flow. We're going to go back to the times that earnings are sustainable, that companies are sustainable, that the stock market's going to be sustainable. Where you're going to have a lot of volatility is in emerging countries. You're going to have it in China, Brazil, India, Russia. That's where you're going to have the ups and downs. But essentially, we are in very good shape here, especially for the long haul.
Well, terrific. Neil, thank you very much for joining us.
Thank you.